Howdy there, folks. Welcome into today's video on the reaction channel. One video and one video only for me to react to in this one. I want to react to the first 7 minutes of Closing Bell today with Cam Dawson, who is absolutely wearing a magnificent purple top. I love it. The hair, holy smokers, that ain't no dang jokers. It's a 10 of 10. Look at the makeup. Is it perfect or is it perfect? Look at Cam go, okay? So I want to go ahead and react to this, kind of give my opinions and perspectives about where this market's at, where this market's going, and all that little fun stuff. I thought this was a good conversation here from Closing Bell today. So appreciate you guys joining me as always. Thanks so much for being here. Thank you for being subscribed. We are now, I don't even know how many subscribers, but we break a new all-time high every single day, so I appreciate y'all being here and enjoying these videos with me.
Knowledge and experience about financial matters, but before losing any key analytical and cognitive skills, I am past my sell-by date.
I have something to look forward to.
And worse and worse. Thanks for watching Power Line.
Tyler, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange, and this make or break hour begins with the market's newfound momentum.
His name's Wapner? I thought it was Scott Walkner this whole time. Literally, the guy's been on CNBC for like 100 years. I really thought his name was Scott Walkner. What in the world? Wap?
Is it real, and can it last? It comes with stocks on the rise again, just as a tough month about to end. Here's your scorecard with 60 minutes to go in regulation. We're green across the board. Some pretty good gains, too. The Dow getting a big boost today from the likes of Verizon and Intel, Goldman Sachs as well. Apple also higher. The company announces a new iPhone event a couple of weeks from now. And speaking of Apple...
Yeah, Apple, those little farts are smart, okay? Those little farts are smart. So Apple, you know what they're about to do? Apple's about to raise price significantly on the very highest end iPhone. Now, it's kind of, you know, the more I thought about it, I'm kind of like, because at the end of the day, there's a certain amount of individuals that buy the highest end iPhone every single year. Regardless, they just buy the newest, the newest, like, the highest end iPhone. And the reason being is they want the best. And so there's many, like even tens of millions of people out there that do this every single year. They want that highest end, biggest iPhone. And so Apple's basically saying, you guys got so much money that you're going to buy these phones, even if it is an extra $200. We'll see if that actually happens. But that's Apple basically saying, it doesn't matter. If you're a business professional, if you're somebody that's got money, you're buying the newest, highest end iPhone regardless. Even if we go up $100, $200 on that, you're still going to buy it. We'll see. We'll see. But that's what Apple's kind of up to there. So rather than raising on the low end, they raised the very highest end possible.
Outperforming today with several of the biggest names in the index seeing nice gains. Meta and Microsoft, Alphabet, Nvidia also higher. And how about another big jump for Tesla? Look at that. Almost.
Oh, and I should say that's rumor news in regards to the Apple price thing I just shared with you. Technically, they haven't announced that yet, but all this stuff leaks way before Apple ever announces anything.
Interest rates, a good part of today's story, too. A couple of key reads on the economy came in a little lighter than expected, and that pushed yields lower almost across the board. 10-year right now at 4.12. It takes us to our talk of the tape. Is the correction over? Was that it? Our stock's now poised to buck the historical trend and get back to gains as we turn the calendar to September. Let's ask Cameron Dawson, the Chief Investment Officer for New Edge Wealth, here with me at Post 9. Welcome back. So how about that?
Yeah.
Are we finding our momentum again?
Well, I think that it is a healthy sign to see this broad-based participation in the upside of the market. It is remaining to be seen if we can get through September unscathed. Our base case is that this will be in that short and shallow category, meaning it wasn't the start of something more nefarious as we looked at August.
You mean the correction?
The past correction that we had. We weren't expecting it to look like 2022, for example, the beginning of something, because it wasn't ever about growth. It was about interest rates. It was about valuations and positioning. So that would say that seasonality likely means during this sideways chop. Does it mean we return to that up into the right market of May, June, and July? Maybe not, but that's very different than expecting a big, deep drawdown.
I think you were looking for a little bit more of a drawdown than we probably got, though, from our last conversations. You know, once we started to look a little edgy in the market, it appeared that maybe, you know, momentum was lost, rates were going up, that we may have a little bit of a problem, even if we, to your point, you know, still weren't predicting a...
Okay, but remember the two biggest things that have mattered in the market the last month or so. Both those things came in way better than expected, right? One was NVIDIA earnings. NVIDIA earnings smashed expectations in terms of the current numbers and the guidance. So that took the whole boogeyman out of the market of, oh, NVIDIA's numbers are not going to be there and blah, 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 and the whole market's going to come crashing down. They just, not only did they take that out, but they took it out and then they said, like, things are going to be way better than anybody had forecast, even the biggest bulls on Wall Street, right? Then you have Jackson Hole happen, and, you know, it was nothing that we didn't expect. Everything that happened in that was expected. Very different than a year ago Jackson Hole with Jerome Powell, where it caught everybody off guard and they're like, oh my gosh, the Fed's serious. They're actually going to raise rates substantially and they're going to keep them there up for a time. This Jackson Hole was pretty, pretty expected. So to get the market to take another huge leg lower, you need something new to happen that would be really devastating, right? That's where things, your whole case around trying to get this market a bunch lower here in the short term is tough.
Still weren't predicting a big decline.
Yeah, and that we never really saw breadth wash out either, meaning that we saw some movement in the participation of things like number of names under the 50-day moving average, but they never got to the place of being fully washed out, which would suggest that, yes, we have seen markets bounce back. We've not made a new high. We've not surpassed that 4,600 level. It will be interesting to see how we interplay with that level. If we can get past it with momentum, then it's a very different story than if we bump up against it, roll over. Maybe you are still stuck in a little bit of a churn digestion.
Why have we hung in there? What's been the determining factor as to why this correction that we started a month thinking a lot about, end the month thinking, well, okay, maybe that was it?
Earnings, meaning that earnings expectations and revisions have actually gone higher over the last 3 weeks, not lower. You started the month at $218 a share for 2023. Now we're at $222 a share. You've seen a similar move higher in 2024 earnings. A lot of that is because economic data is coming in better than expected. Look at economic surprises, really strong over the last 3 months. That has started to roll over more today with the weaker JOLTS data. But I think as long as earnings hold up and you see this continued revision cycle upward, the market can remain supported.
The risk is that once you get into September, you get downward revisions on earnings. That's what I hear more people talking about. Now,
I think one of the other reasons the market's held up well is just like so much offside money. That's been kind of looking to kind of get in this market. And, I've been watching all these folks, because one of the great things about having this reaction channel is I get to watch all these Wall Streeters' opinions all the time and kind of like their sentiment. And I remember a lot. So I remember when these folks are bearish, bullish. I remember when they come on and they talk about they're not invested in anything or they're not invested in this stock. And then I'll watch them 2-3 months later. And next thing you know, suddenly they're in this stock and they're in this stock. And all of a sudden they own NVIDIA and they own Meta now. And oh my gosh, they own all these stocks. And it's like, I remember you guys didn't own anything. Now all of a sudden you guys own all these stocks. I remember all this stuff. So, I think that's another thing that's going on out there in the market. And if we keep kind of rolling in this market, there's going to be a crazy kind of pent-up aggression into the market toward the end of the year, because then at that point in time, fund managers are going to be chasing the indexes. I think a lot of these fund managers are way behind indexes as of right now, and they can't really afford to get much more behind the ball than they are. And so a lot of them are going into, you can say, well, where do these fund managers want to invest into? Well, think about this for a moment. If you're way behind the market because you are way underweight stocks, right? Then how do you get the performance to catch back up to the indexes? I'll tell you exactly how and exactly how they're investing. They're going out there and they're buying the growth stocks. They're buying those NVIDIAs or those AMDs or the Teslas or whatever, because those are the ones that are seen as catch-up plays, right? Because they're usually, if the market does well, let's say the S&P 500 goes up 5%. 5%. Well, guess what? Tesla's going to go up a lot more than 5% usually. NVIDIA is going to go up a whole lot more than 5%. AMD is going to go up a whole lot more than 5%. Meta and all of the rest of them, right? That's how the stock market works. Like those stocks are almost like call options on the stock market in general. So that's where a lot of these folks funnel money, because they're saying, I've got to play catch up. Not necessarily I've got to put my money in the safest place possible. That was more of their view last year. And that's why they sold all those stocks down 50, 60, 70, 80%. They couldn't wait to sell them to anybody buying. And they funneled into their oil and gas stocks and their whatever else they were buying, industrials, whatever, okay? Commodity plays, just sideline money. And they sold and they sold and they sold relentlessly. Now they've been playing catch up, and so a lot of these folks put money into those same stocks that they were selling last year, but those stocks are now 100 or 200% higher, right? But they don't care, because at the end of the day, these folks are just looking at it as, I got to look good to my clients. That's all they're looking at it as. Did we play? Did we play?
Be key. How about yields?
Well, yields did back off today, and I think that does explain the leadership that we had, tech and growth doing better than the rest of the market. I think that the trend in yields for at least the 10-year is still higher. That is one of the few areas of the market that has a very resolute uptrend at this point, which means that I don't know how much I would count on a drop in yields in the very near term to be the ultimate boost and driver for this market. The thing that's been so interesting about 23 is high yields have not mattered for valuations or for the market. So how much will they matter if they start moving in the other direction?
I don't know. Why would they start moving in the other direction higher? And what do you make of the move lower today? Right? What were we just at, like 433, 431? Here we are 412. Yeah. A couple days.
It does speak to how positioning is very one-sided within the bond market, meaning we have these very short futures positionings. Of course, some of that can be offset by positioning in other places. But obviously what we have is an environment where yields are very sensitive to incoming data. Today was immaculate in the jobs data. This idea that you could see job openings continue to come down and not have it yet show up in real job activity, not initial jobless claims popping higher. That will remain to be seen on Friday. We think the most important thing to watch is average hourly earnings. If that remains elevated, that will likely reverse these bets where the bond market started pricing in less interest rate hikes by the Fed, meaning you'll have that upward pressure again, and maybe this yield move continues to drift higher. I
mean, we need the data to be good. We just can't have it be too good, in a sense. And that's what the JOLTS number was today.
Yeah, in terms of a lot of the earnings, when I say earnings, I'm really speaking now about worker earnings, right? And I'm sure you guys have seen what happened with UPS recently. I'm sure you guys have seen what's been going on in the auto sector. And just kind of in general, a lot of that's just kind of like catch up from the past year and a half of going through major inflation, people's cost of living going substantially higher, right? And then workers fighting back against that and saying, hey, we see your guys' earnings and we're getting devastated out here. Like, we need wages up, right? Now, in regards to that, there's a lot of fear around, a wage price spiral where essentially everybody gets wage bumps, then prices go even higher, then people get wage bumps and things like that, right? But the interesting thing is it doesn't feel like that really out there, to be quite frank, when it doesn't seem like companies really have that sort of pricing power right now, unless you're NVIDIA. Like, NVIDIA can charge freaking whatever they want for their chips. Companies are going to pay that. But in terms of what I'm hearing from companies, look at what Tesla's been doing. Has Tesla been going through inflation or deflation? Answer to that is deflation, right? Lowering prices for like pretty much almost a year now at this point in time, right? Look at what these retailers are talking about. Are these retailers talking about inflation or deflation? They're talking about discounting. They're talking about a promotional holiday season. They're talking about gross margins that could get hit into the next couple quarters here, okay? So you just look at kind of industry by industry, and if anything, a lot of these guys are going through more like a deflationary kind of situation there. Now, if we can see the wage picture get better, real wages continue to get better, that could certainly be helpful to the economy next year in 2024, which is a big kind of question mark year. But one of the few bright things we could have is actually real wages moving in a positive direction, which is something that just barely recently started to transpire, which we hadn't had real wages get in a good place for years. And it's finally switching over to the other side, thank goodness.
Well, and I think that the big question for JOLTS going forward is it still a leading indicator? JOLTS and quits are usually seen as leading indicator for things like payrolls and unemployment. We've seen JOLTS and quits come down a lot. They've normalized back towards pre-pandemic levels. Do they continue to fall, meaning that they are presaging something more nefarious in the jobs market? Or do we have this perfect scenario where we can see an easing in the jobs market, but no actual increase in unemployment, which is what, of course, the Fed wants.
What about tech? Before we turn the conversation and bring in two people who really are in their wheelhouse when we talk about tech, what about your view of a trade that was, looking really dicey?
Yeah.
And I don't know, it now feels like it's trying to get its momentum back and may have.
Yeah, I mean, we saw tech underperform from mid-July to mid-August, and now it's been outperforming since mid-August. And I think that we do have to ask the question of, can tech valuations move that much higher from here, meaning that they are back near their 2021 highs? That puts the onus then on earnings to drive the upside in tech, just because how much can you move tech that much higher above 2021, which would...
It frustrates me that people like to put all these tech stocks together. Okay, no, you can't. These stocks all have such different stories. NVIDIA's story is so much different than Apple's. Apple's story is so much different than Meta's. Meta's story is so much different than AMD's. AMD's story is so much different than Tesla's. This is a haves and have-nots market. Some of these companies are going through some really tough times right now. We're going to continue to. Some of these companies, things are getting much better for them and are going to get exponentially better over the next few quarters. Some of these companies, like an NVIDIA, for instance, it's like the greatest times ever for them, right? So to try to lump all these big tech stocks together is foolish. Look at the revenue growth rates of these companies. AMD was down 18% last quarter. Apple was down last quarter. NVIDIA was up over 100% revenue growth last quarter, okay? Meta's revenue growth, healthy. PayPal's revenue growth, very healthy. Netflix's revenue growth, healthy. Microsoft's revenue growth, healthy. You gotta look through these stocks a little deeper than just like, they're all the same. They're not the same, man. To group them all as the same thing, it's a foolish idea. It's a foolish idea, but we do know Wall Street can be very foolish.
One, which was incredibly elevated multiples without the benefit of earnings growth, which we are seeing earnings revisions higher for tech, just like we are the broader market.
Multiples have come in across the board for the mega caps since the beginning of August till today. Now, obviously, you're going to get that when you had a little bit of the upset in the performance, but nonetheless, valuations have started to ease off a little bit. Let's expand the conversation.
So I love this part right here, okay? Showing these different companies forward PEs, right? Because it looks like, NVIDIA's trading a little rich compared to Apple. Yeah, but Apple's revenues are going down. NVIDIA's revenues are going up triple digits. NVIDIA nearly 10x their bottom line. Apple's bottom line is trying to even stay above water right now, right? So this is a haves and have-nots market. This is a divergence market of tech, and don't just group all these guys together. It's just the wrong way of looking at this market, I can tell you that. And it will come back to bite a lot of folks in a huge way because they will miss out on some incredible gains over the next, let's just call it over the next 12 to 24 months, and they'll set themselves up for some pretty big downside if you think all these tech stocks are equal, because they are not, folks. I appreciate everybody joining me as always. Thanks so much for being here. Thanks for being subscribed to the channel. Much love as always, folks. And if you're looking to follow me on IG, if you're looking to apply to join my private group, any of those sorts of things, join my Patreon, then check out the description area down there. Much love and have a great day.